GC. So talk me through this graph with these new data sets that we have in front of it and how to think about it.
Well, I'm so glad that you guys are here right now talking about this. This might be the most impactful Jacksonville real estate market update we've done, because up until now, it's been ho-hum. We have really low months of inventory and we are below the median home projected price trend right here, which is that red line. And when you see both of those things, it's a pretty easy thing for us to look at, all of us as investors, and say, well, we probably think home prices are going up, if you understand how those metrics are tracked there. So now, what do we see, everybody? We see that the median home sales price in Jacksonville is above the projected median home sales price. What does this mean, right? Now you need to rely on experts a little bit more here. You need to dig into this a little bit more, because if you're looking at this in a vacuum, you're like, Greg, if you're saying that overall long-term things come back to the normal, if I'm above the median right now, does that mean that it needs to go down to return to the normal? And the answer long-term is yes, right? If this works the way that it has worked since whenever we have been tracking real estate values, what you'll see long-term is that this average home price appreciation rate will not be as high today, or will not be as high in the future as it is today. It will come down to the norm, and that median projected home sales price will meet it. Now, the big differentiator from what you're probably reading in a lot of the headlines is that this does not mean a crash, right? This does not mean that home prices are going to decline, right? I'm sitting here telling you that I think home prices are going to go up from now, right? Especially over next year. What this means, and what normally happens in real estate, is you see lower than normal home price appreciation to get you back to that median projected home sales price. And that's most likely what is going to happen. Now, of course, we need to monitor this, right? We're going to continue to monitor this, right? We know what we know right now, and right now there's really low supply, right? We know that builders are building. We know that there's still low interest rates, so demand is really high. We know population growth right now is really high in Jacksonville, and that's why we think home prices are still going to go up over the next year. But long term, what's most likely going to happen is that you will see lower than 4.3% home price appreciation. That does not mean zero. That does not mean negative, right? We're going to monitor that. If I start to see things happen that would lead to that, I'm sure going to share it with you. But I do want to make sure people can lean into this data, look at this and say, okay, this is where we are. This is one data point. We need to look at a few other things and know that just because you are above that trend line does not mean that you are going to go below. Just like, in 2016, when we were below the home trend line, I didn't think you were going to shoot up to that trend line the next year, right? The same thing happens. You gradually tend to get back there. And that's most likely what will happen based on the chart that I'm looking at right now.
So I've looked at this chart a bunch of times, and right now I'm looking at it with slightly different eyes, right? Like I'm looking at it in the sense of, okay, what happens now that we're above this red trend line? And I think it's easy to look at this thing and think, okay, well, if I'm above this trend line here and I was above it down here, it's going to look kind of like it did from 2006 to 2011 and just come down precipitously. That's not really the case. It's probably more likely, or I don't know what's more likely, right? But there's options, right? There's the option of this is home price. So it could just kind of go flat for like a little while and the price could stay the same. Homes don't lose value. They just stay completely normal. It could be slightly ascending, just at a lesser rate than it's been since it's been catching up to this thing, and hold that for a while. And, home prices, it can return back to the medium of 4.3%. It could also take that precipitous decline. But I think there's also a chance, right? If what's our friend that was with us, that was the real estate expert, that John Burns?
Yeah.
He talked about the idea that months of inventory has reached a new normal, and months of inventory is not going to go back to 6 point something. It's going to normalize somewhere around the 4s. There is also the chance that over the next market cycle, there will be a correction in Jacksonville real estate, and it might end up turning into a 5%, 5.5% higher than normal home price appreciation with all these tailwinds that are going in and with all these macro changes that have happened to the economy of people moving to better climates and all these other things that are happening, right?
You're 100% right. Right. What we're sharing with you is the best information that we have today. But what we're looking at here is a long-term pricing indicator, right? This is not something that you can say, it's not in a vacuum for sure, right? We're talking about 10 to 20 year timelines of holding on to rental properties. A lot can change in 10 to 20 years. If you're looking at this and you're saying, well, is Jacksonville more likely to have a higher trend line than 4.3% or a lower trend line than 4.3%, I think you could sit here and say that it's more likely based on the things that you were talking about, Pablo, right? Population growth, right? The world is different today than it was in 2019. And Jacksonville is an affordable market where people are not tethered to their job and can live here and, run on the beach with Pablo and I on Tuesdays and Thursdays, which you can't do in, Sheboygan. So, there's a lot in, the business friendly climate, right? No state income taxes, right? There are a lot of reasons that you could say there would be some sort of shift, but that 4.3% number that I constantly reference it's kind of like a tethering point for me, right? It's going to be somewhere around there. I'm not going to sit here and say it's going to be 4.3%, right? It might be 4.5, it might be 4.1, but think about this, right? In your property evaluations for JWB, we represent 0% home price appreciation, right? If you're thinking about where you're putting your dollars and you think you're going to put it in the stock market, you earn 7 to 9% returns on average over the long haul in the stock market. Well, in rental properties, you earn 7 to 9% without even talking about home price appreciation, right? 7 to 9%, 7 to 9%, right? Then if you just get 4% home price appreciation in rental properties and you use smart debt, right? That pays for itself every single month. And you put 25% down. That's really like you getting a 16% return on investment. So to me, and just from that home price appreciation, so your real return is like 23% in rental properties, right? So to me, I get less, I'm less apt to say, well, is it going to be 4.3 or 4.5 or 4.7 or 4.1? To me, I know it's going to be somewhere around, call it 4% or 4.5%. And when I run the math in my head and I think, well, every point of appreciation I get, I multiply that times 4 because I use debt. That's where it absolutely stands out long-term as being a better investment than the stock market in my mind, right? So did I answer your question well there, Pablo?
Yes, you did.